Hi there, this is Mr. Evans. This video is on sources of finance. You need to be aware of internal and external sources of finance, the advantages and disadvantages of different sources of finance, and long and short-term uses of sources of finance. Specifically, you need to be aware of these 6 sources of finance. So, sources of finance, as the name suggests, these are places that a business can get money from. You need to be able to distinguish between internal and external sources of finance. So internal sources of finance are generated within the business or by their current owners. So this could be by selling off assets that the business has, that would provide them with some money, or by their current owners investing more money. That would be considered internal finance as well. External finance obviously comes from outside the business. This would be things like borrowing money from a bank, or finding new shareholders to invest their money. These are sources outside of the business. You need to be aware that different sources of finance will be appropriate for different situations depending on what the use of that finance is expected to be. So the specification says short-term use of finance. I would call this revenue expenditure. If we want a source of finance to pay for things like running costs, for example, the purchase of raw material, to pay staff wages, this would be classified as revenue expenditure. Revenue, money we're getting. We're spending money on stuff to get money in the short term. So if we had to put a timescale on it, I would say that short-term sources of finance are to be used up within 1 year. Long-term sources of finance then are sources of finance that will be used to generate income for the business for over a year's time. So these will be in the business for more than a year, and we could call this capital expenditure. So funding the purchase of assets like machinery and property, etc. So revenue expenditure is money used to generate revenues, i.e. buying raw materials or paying staff wages. Capital expenditure, long-term money that's going to be used to purchase assets like machinery and property that will be in the business for long-term, i.e. over 1 year. So there are 2 main internal sources of finance that you need to know about. These are identified on the specification. The first one is debt factoring. Debt factoring occurs when so this is an interesting source of finance, especially the first one that's on the specification. Debt factoring would really only be used if a business was in a situation where they were in a bit of trouble. It's not the first place that you would go to raise finance. What debt factoring is a debt factoring company is one that buys debt from you and will chase it up. So, for example, if you have a customer who you've sold them something on credit, they've given you an IOU. They said, yeah, I'm going to pay for this, but I'm going to pay for it in 30, 60 or 90 days. And you decide that you need that money before. So let's say a customer is going to give you £1,000 in 90 days, but for some reason you suddenly need that money before that is due to you, you may well sell that IOU to a debt factoring company. Now then, the debt factoring company would then own that IOU and be able to chase the customer up and collect your £1,000. They would buy the £1,000 IOU off you for something like £900. So you would be selling a £1,000 debt that you are due to collect and getting £900 today, or perhaps even less than that. So This is a short-term source of finance. You wouldn't use debt factoring to fund the purchase of a new building or anything like that. This would really only be used in an emergency, and it's considered internal finance. You're really selling one of your assets to earn this money. The advantages are it's going to provide you cash in the short term, it's going to reduce risk of bad debt, i.e. it's not your responsibility to chase up the client anymore, the person who's bought the debt will do that, and this will cost you less in the future if there are any problems chasing up that debt. However, you may only receive sort of 80% of the sale value, 90%, 800, they might be buying that £1,000 debt for £800, £750. So, this is not ideal. You would try and avoid this if you could. Could also cause reputational damage for your business if the debt factoring company is particularly aggressive in chasing up customers. They would probably blame that on you. So that's one internal source of finance you need to be, short-term source of finance you need to be aware of. The other short-term source of finance that's listed on the specification that you need to be aware of is an overdraft, which is an agreement with a bank that you will be allowed to overspend on a current account up to a set limit. So let's say you have £100 in your business bank account, you get a £200 gas bill, then an overdraft would allow you to pay that gas bill, and you go in debt to the bank. You owe the bank, your current account balance would read minus 100, and then you would need to pay that back to the bank. So what are overdrafts useful for? Well, they're particularly useful to cover seasonal changes in demand, or cover short-term shortfalls of cash, i.e. awaiting payment from a customer. So, if you, this is an overdraft is really helpful if you need to go overdrawn for a couple of days, a week maybe, and it's quite a commonly used source of finance. The advantages are these are flexible. You don't usually, you agree your limit. Let's say we've got a £20,000 limit on a business overdraft, and you don't need to tell the bank you're going to go into it. You can just keep on dipping into and out of it, which should help you to deal with seasonal fluctuations in demand and enable you to respond to unforeseen events. However, there's a relatively high rate of interest charged to have the convenience of doing this. And the overdraft, in theory, can be recalled at any time by the bank, but that's very unlikely to happen. I mean, I had an overdraft when I was at university, for example, and I never heard of anyone having their overdraft limit recalled by the bank. I don't think it happens to businesses very often either. But in theory, that is a disadvantage of an overdraft. And if you are looking to negotiate a larger limit for an overdraft, maybe £100,000 or something, you may need to support that with business plans, cash flow forecasts, some sort of evidence that you will be able to pay that back to the bank, which can be time consuming. So we've covered the two short-term sources of finance that you need to be aware of. That's debt factoring and overdraft. The next video will look at the long-term sources of finance.